Hey YouTubers, welcome to the channel. This is Everyday Finance and I'm your host, Bobby. If this is your first time on the channel, go ahead and smash that like, subscribe, and notification bell so that you'll get notifications about future videos that has content similar to what you'll see in today's video. In today's video, I'm going to talk to you guys about home ownership. I'm going to talk about everything that's needed in order for you to make your home ownership goals a reality. So let's go ahead and jump right into it. Guys, with the global pandemic, federal interest rates have hit historic lows. If you've been thinking about buying a home or are in the market right now to buy a home, now is the time to do so. But with these historic low interest rates, let's talk about what you'll need in order to take advantage of it. All right, guys, so the first thing that you'll need is credit. All right, so credit is king. There's no way around it. The credit score is something that you will need and that will follow you for the majority of your life. Unless you're a high net worth individual where you can pay for or buy things in cash, you'll need a credit score in order to qualify for things. Homes are no different. With home purchasing or home buying, you'll want to have at least, at a minimum, a 620 credit score. Now, I don't want to try to diminish or have anyone who doesn't have a 620 credit score feel like they can't get a home, because it is possible to get a home outside or lower than a 620 credit score. However, with having a lower score, the likelihood that you'll have a higher interest rate and also higher payments over the duration, the time of the loan, is also something that you'll want to take into account as well. Now, you want to make sure that your credit is great. Okay, the better your credit is, the lower your monthly payment and the lower interest rate that you'll be able to take advantage of. In addition to that, part of your credit is your credit report. Now, with your credit report, anything that you have on your credit report, you're going to want to assume that it's going to be gone over with a fine-tooth comb by lenders. So any mortgages, any bankruptcies, any repossessions, any collections, any liens or judgments, you're going to have to discuss in further detail and give an explanation for it to lenders in order for them to see you as being credit worthy enough to qualify for a mortgage on a home. Okay, so now that you've checked the box in terms of having good or decent credit, the next step is to verify or have verifiable income for the last 2 years. Now, don't go trying to find pay stubs for the last 2 years. Can you imagine trying to do that? Find pay stubs for the last 2 years? No one will be able to do that. In terms of your pay stubs, you'll only need anywhere between 30 to 60 days worth of pay stubs, depending on your pay frequency. Now, in terms of the 2-year span of verifiable income that I suggested, that would be covered by the previous 2 years tax return. Now, in addition to your 30 days or 60 days worth of income statements, the tax returns together with that will be verified and gone through by an underwriter. They just want to see where your money is going and how much you've earned on an annual basis, in addition to whatever your regular pay frequency is. Now, even though you've done that, verifying your income is not done. Now, if you think that that process was extenuating, then just wait. The next step is even more scrutineous. All right, so in addition to having your pay stubs and 2 years worth of tax returns, you also want to do the same with bank statements. Now, whatever it is that your money that you're receiving either from your job or your self-employment income, however you're paid, wherever that money is going, your lenders are going to want to see it. In addition to that, if there are any large deposits that are showing outside of the money that you'll earn, you'll have to source it, along with any payments that you make regularly or any large infrequent payments. So when going through your bank statements or when turning your bank statements over to your mortgage lender, sometimes you'll have them come back or contact you with multiple questions in regards to something that's showing on your bank statement. And it may be something like you lending money to a friend or paying for a one-time thing. But in all cases, you'll want to source that so that they'll be able to verify where your funds are going and how much you're receiving of that as well. This process of income verification can be very frustrating. You'll be hit with multiple questions that you may or may not have to dig for in terms of your answers. Now, sometimes we have to put ourselves in the place of the lender. They'll want to ask or minimize as much risk as they can during this process. In addition to that, if you have any income outside of your regular paychecks, say any dividend income, any fixed income, things of that nature, you'll have to source that as well. So that's another step in the process. Okay, so we've checked the credit box. We've went through the rigors of verifying our income and bank statements. What could be next? I'll tell you what's next. Your DTI. What is DTI? DTI is your debt to income. DTI is the amount of debt that you currently have relative to the amount of income that you currently have. And DTI is calculated by you take the maximum amount of debt that you currently have and you divide that by the amount of income that you have. And that's usually expressed as a percentage amount. Now, currently with conventional loans, 43% in terms of a DTI percentage is the number that you want to be cognizant of. Government loans allow up to 50% DTI. You want to make sure that you are aligned within those parameters when it comes to qualifying for a mortgage, depending on what lender or what mortgage program you're using. That was a lot, right? The good thing is that the income, credit, and DTI, it's a large chunk of what you'll have to do in order to qualify for a home or a mortgage loan pre-approval. That was a lot, right? It can be frustrating, and sometimes it'll make you think twice about going through the home buying process, but I promise you it's worth it in the end. When you get to get your keys and open up your home and spend your first night there. Now, the next step in this process is to understand the programs that are available to you. FHA, VA, USDA. Does it sound like jargon? It isn't. These are the names of some programs that may be available to you. In this particular instance, VA is a program that's available to veterans of the United States Armed Forces. Now, with this particular program, they offer 100% financing through this program. They may offer some other incentives such as no closing costs and things of that nature that are specific to this program. In the case of USDA, it's a program that offers assistance to people who look for homes in more rural areas. And there also are some income specifications as well, where you have to be within a certain threshold in order to qualify for them. The important thing with all of this is to be cognizant of what programs are out there and what are available to you, both because of what you've done in your life in terms of how you earn a living and also where you're looking for a home. Now, we're heading downhill in terms of what's left in the home qualification process. Now, the next step in this process is to become pre-approved. Now, pre-approval in and of itself is a combination of the previous steps that we listed in terms of getting qualified through credit, having your income verified, and being within the thresholds of DTI. Now, with pre-approval, pre-approvals are typically good for at least 3 months. Now, it does vary based on the mortgage lender and servicer that you're using. So, but within a general format though, 3 months is about the time that pre-approvals are good for. Now, the reason why you want to have a pre-approval is because part of this process is actually finding a home. With finding a home, you need to contact a real estate agent, or if you know someone, go through them. And when you have a pre-approval, it allows them to know that you've pre-qualified up to the point to where you almost have money in your hand when it comes to purchasing or looking at homes, so that they know that you're a serious buyer or you're a serious person looking for homes at this point. The last step in this process too is to actually go out and look for a home. Now, if you have something specific in mind in terms of a floor plan, in terms of square footage, in terms of how many bedrooms or bathrooms that you want, it's good because it can help you narrow down exactly what it is that you're looking for and the areas that you're looking for within. Guys, so we've talked about home ownership in this video. We talked about qualifying with a home with a credit score of at least a 620. We talked about income verification with pay stubs for the last 30 days, tax returns for at least 2 years, bank statements for 30 to 60 days depending on your income. In addition to that, we talked about DTI, the debt to income ratio, making sure that you stay within 43% for conventional programs and up to 50% for government programs. Also, we've talked about pre-approvals, noting that they'll last for at least 3 months in most cases or in general. And we've talked about the most strenuous process, which is actually going and looking for a home. I really hope that this information helps you alleviate some of the concerns or frustrations that most people have in the home buying process. If it has done so, be sure to leave a like. If you've enjoyed this content, guys, be sure to subscribe, hit that notification bell as well so that you'll get updates on future content similar to what you saw in this video. Guys, always remember, there is no goal that is unobtainable when you apply everyday finance. I'll see you guys in the next video.